Okay, I was going to go ahead and work this problem out from a SEPI. What we're going to do is they've already have a link for us for some data. So I'm going to go ahead and click on this link. Now you could similarly get this data if, go ahead and open it up. And you could get this data from Yahoo Finance or somewhere also. But this is just the daily price data for the S&P 500. Of course, Yahoo Finance just changed where you can't download the S&P 500. But you could like highlight it and copy and paste it in here once you go look at it on Yahoo. And then also this is 5 other companies, and it's the month. It looks like it's the monthly prices. Okay, so sometimes just to make it make more sense, we could go ahead and change that to dollars just to show that they're dollars. And if we go back to the problem, so we have that. So that's so we have that. So they want to know the monthly return for Unilever from January to February in 2015. So now remember, when you do returns, you need the previous month, right? So my first return is gonna be here. So what I could do, I could go returns, monthly returns, and then I'm gonna go equals since we're gonna lose 1 month, right? Because we have to use the previous month to get started. And so for the S&P 500, the return is going to be equal to this month divided by the previous month minus 1. And we can put that as percent. Take it out a few places. And you can see from January 1st, 2015 to February 1st, 2015, it went up to around $210, so it should be a positive return. And we do get a positive return of 5.7474%. And we can take this across and then copy it down. And we have all the returns. So the first question was asking was, what is the monthly return for Unilever from January to February? Well, this is January, this is February, and this is Unilever. So I can just go ahead and copy this and paste this in here. And that's the answer. All right. So part 2, it asks for the monthly return for an equally rated portfolio of 5 stocks, excluding the S&P 500 from January 15th. So it says equally weighted. So we could do the portfolio return. Maybe we could go return of the portfolio. I'll use a small letter. Return of the portfolio. And we probably should put the weights here, right? So I'll go, we could go, let me go equals. So we're not going to do the market, we're just going to do the companies. So we can put these companies here. And we can go, and if it's equally weighted, well, there's 5 companies, so it's going to be equal to 1/5, right? So, or I can put that as percent. So we're going to have 20% of our money in each one of these. So if I had $1,000, I'd have $200 invested in each one of these company stock. We can call this the weights. All right. So now we can do the return of the portfolio. It's just simply equal to the sum product. Remember, portfolio return is just like a weighted average. So these are the weights. I'm going to go ahead and F4 that because I want to copy that down, and I always wanted to point those weights. And that's going to be times these returns. And then I just copy that all the way down. So for these weights, if I have 20% of my money at the start of each one of these periods, and my returns are this is what my, so basically I'd have to rebalance every time, you know, because the percentage of my money would be different, obviously, since the value goes up and down for each month. But anyway, so they're asking for, I believe they're asking for, excluding S&P 500, January to February 2015. This is January to February 2015. So it would be this answer right here. So I can go ahead and click on it. Control C, alternate tab, Control V, submit, and that's correct. Okay. So far we've answered this question and that question. All right. So let's look at the next question. It says, regress the returns for each stock in the portfolio on the returns for the S&P 500. What is the R squared for the regression of the portfolio? Okay, so so we could go here, R squared. And I'm going to put portfolio over here too. This actually happens. This return, the weight for the portfolio is just going to equal to this, is going to be the sum of these, right? So that's 100%. So R squared for each one of these. So we're regressing these. So the R squared between Coca-Cola and the S&P 500, that's basically what you want. So I'm going to go equals R squared, RSQ. They want the known Y's. Well, the known Y's are going to be these Coca-Colas. And the known X's is going to be the S&P 500. Now I'm going to F4 that S&P 500 because I want to regress it all for all these all the way across. So my R squared for every one of them is going to be like that. You click on that one, it's going to be the S&P 500 nat. You click on that one, and so on. And they want to know the R squared of the regression for the portfolio is going to be this right here. So I'm going to go copy and paste, and that's correct. Okay. And finally, what is the R squared of the regression for the portfolio with the following weights? So I can do some more weights. Just let me copy this down again. All right, so this is one answer. I got to be careful because this, this is equal to that, right? So let's just copy that across. And so now we got to be, so the weights are still be the same. So now we want to do the R squared again. So let me copy this and paste it. The only thing I got to be careful is since we moved it, these move down. So I got to move. Oop. I'm just going to drag this back up. Since I copied it down, how many did I copy down? I copied it down 1, 2, 3, 4, 5, 6. This didn't move with that dollar sign, but this moves. So I got to drag it back up. And then I can drag this across. It should be the same answer. But now we're going to change the weights. So the weights are 0.15, 0.12, 0.15, 0.15, and 0.35. So I'm going to go 0.15, 0.2, 0.15, 0.15, and 0.35. So now they want to know the R squared of the regression of the portfolio. It's going to be this one right here. So I can go copy and paste it in here. Check. And that's the answer. Okay. So that's pretty easy. Now, so you can stop right there, and you got that. I just showed you how to solve that, but I'm going to show you. We can do some other very interesting things here too, can't we? We could calculate things like the R squared. We could calculate the beta. We could calculate the expected return. All right, of each one of these. We calculate the standard deviation. I can go insert standard deviation, and so we could calculate a lot of interesting things. So the beta would be equal to the slope, so the known Y's is going to be these Coca-Colas, and the known X's is going to be the S&P 500. Again, I'm going to F4 that S&P 500 because I want to copy this across. So I calculate the betas for each one of these if I wanted to, and then for the portfolio. And I could calculate the expected return. So the expected return is going to be equal to sum product. Well, hold on. This expected return for Coca-Cola is going to be equal to the average of all the returns. Right? So that'd be the expected return for Coca-Cola. And for each one of these. So this is the weekly or the monthly expected return. The expected return for the portfolio is going to be equal to the sum product of our weights times our expected return for each individual security. And we can do the standard deviation of each and go equals standard deviation. I'm going to do a sample standard deviation, and I could highlight these and shift it and down and copy that across. And so we're going to use those standard deviations also in percent, so I'll copy that format. Okay, so oops, I don't want to do that. So if I go over here, okay, so this is the expected return of the portfolio. I did it this way, right? I also could have done it. So these returns on this. Okay, I gotta be careful because this was calculated using the sum product of those, right? So if I'm doing this bottom one, I got to drag it down, right? And then I would have to copy this down like this. So I got to be very careful there, right? Let me. Okay, so I got to be careful here because I'm using a different weights. This is a different problem when I go down here. All right, so we could double check this. So I calculated this using the sum product, but I also could take the average of these, and it should give me the same answer, right? And so that's two ways to calculate. Just take the average of it or that. All right, so what we could do is very interesting here. These are our portfolio numbers, and these are really the more important things, right? These portfolio numbers. So now remember this changed now, so it's not going to be the same because I changed it. I'm using when I'm calculating these, I'm using these weights, right? So that number is not what it originally was. But anyway, I want to show you something that also is very interesting here. I could now do some things. I could calculate the expected return divided by the variance, or by the standard deviation, and so that's kind of like a modified Sharpe ratio. So it's the return per unit risk. Or I could just try to minimize my risk by changing these weights. And I may have showed this to you before, but I'm just going to show you again just to reiterate. So you can do some very things. So I'm going to calculate this. This is equal to that divided by that. Oops. Equals that divided by that, right? And this is a unitless number because I divided percent by percent, so I'm going to make it a decimal and drag that across. And so you can see some things right here. So if you look at the risk of each one of these individual securities, it's fairly high. But if I diversify by doing this percent, maybe we would just do it, you know, doing these percents. If I just diversify it by that, I've lowered the risk, but I've got a fairly high return, right? And I also, my risk adjusted return is actually the only investment that's lower than that is PEP, Pep Boys, I think that is. But then for Pep Boys, the risk is higher. Well, no, the risk is actually lower. Okay, so Pep Boys, but but you're also getting a higher return for higher risk. Anyway, we can do it. I'm going to go to Solver, so I'm going to go to Data, Solver. I can say, you know what I would like to do, I would like to minimize my risk. So I want to minimize my portfolio standard deviation, which is this one right here, by changing these weights right here, right? And I want to add some constraints. I want to say that this has to equal 1 because I only use 100% of my money. And I also want to say, I want to add some more constraints. I want to say all these are less than or equal to 1. And I also want to say all these are greater than or equal to 0. So I just want to make sure these weights don't go crazy and go outside of those bounds. And again, we want to minimize we want to minimize that risk. And then if I go solve, so now we've got the risk a lot lower. In fact, we got the risk lower than any of these individual securities, didn't we? By changing the weights to this. So now we've actually lowered the risk, and we actually got a very good Sharpe ratio still. And our expected return is not bad. So so Solver balanced our portfolio automatically by just telling it to vary these and make this as low as possible. So there we got our minimum variance portfolio out of those 5 things. So anyway, I'm going to stop there. I got other things I'd like to show you, but we're kind of out of time. I don't want to spend more time than we already have. I just wanted to show you this is kind of a cool problem. You can look at some other things too. So this is like the benefits of the diversification, right? We're diversifying. We're lowering our risk below any of the individual risks. We're getting a fairly high return just by diversifying. So this is just like an expansion of when you look at 2-stock portfolio or a 3-stock portfolio. You can do as many stocks as you want. You still could diversify. And what's cool, Excel can actually figure it out. So, so if we actually take this out to a few places, you would want 43 points. So let's say we're investing $10,000. The amount to invest. I'm going to put the amount over here. Amount to invest in each stock would be. Let me move this over so we're going to invest $10,000. The amount we invest in each stock would be equal to that times that F4. So I would invest that amount of money of my $10,000 in each one of these stocks, and the number of shares. Well, the number of shares, we could just use the price that we last paid would be equal to how much money we're going to invest divided by, well, the last month we know of, the price was right here for Coca-Cola, right? So I'd buy, let me take that down a few places. We buy 96.26 shares of Coca-Cola. We copy that across. So this is how many shares you would buy using the last known price. Okay? So you could actually figure out exactly how many shares you would invest in order to get that minimum variance. We also maximize we could also maximize this. I could go Data, Solver, and let's say I want to maximize, I want to maximize my Sharpe ratio. And if we go Solve, so this is what you would do in order to get your Sharpe ratio. So again, we got our Sharpe ratio higher than any of the Sharpe ratios of the individual ones. And this is how you would invest right there. Okay? So you'd buy 1.2 shares of that, 77.14 shares of that, and 16.83 shares of that. Now you can buy partial shares depending on where you're buying. Partial shares, you can buy those now. at most brokers. All right. So anyway, my picture is going to come up. If that was interesting to you, click on my picture if you haven't subscribed. As usual, give me a thumbs up if you like this video. Thanks for watching.